here at Inside ETFs. We're going to talk to a number of industry experts about their products and what's ahead for the rest of 2018. Hi, I'm Todd Rosenbluth, back here at Inside ETFs. I'm here with Luciano Siracusano from WisdomTree. Luciano, let's talk about dividends and the role they should play in an investor's mindset with ETFs.
Well, dividends are key. Over long holding periods, dividends is one of the things that drives the stock market. Historically, dividends grow about 5.5% per year. So we think it's essential in a portfolio to try to, if you can, maximize the dividend growth of what you own.
So not only does WisdomTree have US-based products like DGRW, but there's a number of international products. Hedging has been something that you guys have been thinking about for a while. Dynamically, is that the case?
Yeah, in the US, you mentioned DGRW, that's a unhedged US position, that's quality dividend growth, large cap portfolio that has higher return on equity than the market and lower leverage, which we think is important in a rising rate environment. Internationally, we give investors a way to get markets unhedged, hedged, or dynamically hedged. And right now, we would be steering folks towards dynamically hedging. It's the idea that the index will make the decision for you which foreign currencies to hedge out. Right now, it's about 50% hedged. But the reason we do that is because over long holding periods, having the foreign currency exposure doesn't add to your total return historically. It adds to your volatility. In any given year, you might win, you might lose, but over a full cycle, we don't think it's a source of return. And therefore, we think you should be, on balance, hedging a lot of it out to try to bring down overall vol.
So that's an example of one of your non-market cap weighted international approaches. Looking at emerging markets, there's been a relatively popular product looking at non-government oriented or non-state-owned companies.
Exactly. So in emerging markets, this is an example of what WisdomTree calls modern alpha. We're trying to give you a way to own the emerging markets broadly, but exclude the 25 to 30% of the market where governments own at least 20% of that company. So last year, emerging markets were up 37%. If you had excluded these state-owned enterprises, like WisdomTree does through XSOE, we were up 47% last year. So we added 1,000 basis points above beta just by giving you private sector beta and letting you exclude companies where the government is looking over their shoulders.
Thank you very much for stopping by the CFRA booth here at Inside ETFs.
Thank you.